When it comes to building long-term wealth and protecting your financial future, few comparisons are as debated as whole life insurance versus index funds. On one side, you have whole life insurance, often promoted as a guaranteed, all-in-one financial solution that offers protection, stability, and cash value growth. On the other side, you have index funds, widely praised as one of the most effective and accessible ways to grow wealth through the stock market. Both are frequently recommended by financial professionals, yet they serve very different purposes. So which one truly comes out on top? The answer isn't as simple as choosing a winner. It requires understanding how each works, what they're designed for, and how they perform over time. Today, we will talk about whole life insurance versus index funds. The ultimate showdown. So, before we start, make sure to hit the like button and subscribe to my channel. Let's start by breaking down whole life insurance. Whole life insurance is a type of permanent life insurance that provides coverage for your entire life, as long as you continue paying premiums. It combines a death benefit with a cash value component that grows over time. Part of your premium goes toward the cost of insurance, while the remaining portion is invested by the insurance company to build your cash value. This cash value grows at a guaranteed rate, often supplemented by dividends depending on the insurer's performance. One of the main selling points of whole life insurance is its guarantees. You are promised a death benefit, predictable growth, and fixed premiums. This level of certainty can be appealing, especially for individuals who prefer stability and want to avoid market volatility. Additionally, whole life insurance offers tax advantages. The cash value grows tax-deferred, and policy loans can often be accessed without immediate tax consequences. The death benefit is typically paid out tax-free to beneficiaries, making it a useful tool for estate planning. However, these benefits come at a cost, literally. Whole life insurance is significantly more expensive than other forms of insurance. A large portion of your premium goes toward fees, commissions, and administrative costs, especially in the early years. This means that your cash value builds slowly at first. It can take several years before the policy becomes efficient, and if you surrender it early, you may lose money due to fees and surrender charges. Now let's turn to index funds, which represent a completely different approach to wealth building. Index funds are a type of investment that tracks a specific market index, such as the S&P 500. Instead of trying to beat the market, index funds aim to match its performance. This makes them a passive investment strategy, which is one of their biggest advantages. One of the primary benefits of index funds is their simplicity. You don't need to pick individual stocks or constantly monitor the market. By investing in an index fund, you gain exposure to a broad range of companies, which provides instant diversification. This reduces the risk associated with investing in a single company or sector. Additionally, index funds typically have very low fees compared to actively managed funds, which means more of your money stays invested and working for you. Over the long term, index funds have historically delivered strong returns. The stock market has averaged around 7% to 10% annually over extended periods, making it one of the most powerful wealth-building tools available. When combined with consistent investing and compound growth, index funds can significantly increase your net worth over time. Now let's compare the two directly. One of the most important differences between whole life insurance and index funds is return on investment. Whole life insurance typically offers lower returns, often in the range of 3% to 5%, while index funds have the potential to deliver higher returns over the long term. This difference may seem small at first, but over decades, it can result in a substantial gap in wealth accumulation. Another key difference is liquidity. Index funds are highly liquid. You can buy or sell them at any time during market hours. This gives you flexibility and access to your money when needed. Whole life insurance, on the other hand, is less liquid. While you can borrow against the cash value, doing so may involve interest and can impact your policy if not managed properly. Risk is another major factor. Index funds are subject to market volatility, meaning their value can go up and down. However, over long periods, the market has historically trended upward. Whole life insurance eliminates market risk by offering guaranteed growth. This makes it a safer, more predictable option, but also limits its growth potential. Let's talk about control and transparency. With index funds, you have direct control over your investments. You can choose which funds to invest in, how much to contribute, and when to make changes. The structure is simple and transparent. With whole life insurance, the structure is more complex. Policies can include fees, riders, and provisions that may not be immediately obvious. Understanding exactly how your policy works often requires careful review. Now, let's address a common misconception: that whole life insurance is an investment. While it does have a cash value component, it is not designed to compete with investments like index funds. Instead, it is primarily an insurance product with a savings feature. Index funds, on the other hand, are purely investment vehicles designed for growth. This fundamental difference is why comparing them directly can sometimes lead to confusion. So which one is better? The answer depends on your goals. If your primary objective is to maximize wealth and achieve the highest possible returns over time, index funds are generally the superior choice. Their higher growth potential and lower costs make them an efficient wealth-building tool. However, if your priority is stability, guarantees, and long-term financial planning, whole life insurance may serve a valuable role. Another important consideration is behavior. Many people struggle with investing due to emotional decision-making. They may panic during market downturns or fail to invest consistently. Whole life insurance enforces discipline through fixed premiums and structured contributions. While this may limit flexibility, it can help some individuals stay committed to their financial plan. Tax efficiency is another area where both options have strengths. Whole life insurance offers tax-deferred growth and tax-free access through loans, while index funds benefit from favorable capital gains tax rates and tax-efficient strategies like long-term holding. Depending on your income level and financial situation, one may offer advantages over the other. It's also worth noting that these two options are not mutually exclusive. Many financial experts recommend using both as part of a balanced financial strategy. For example, you might invest in index funds for growth while using whole life insurance for estate planning, risk management, or legacy building. This combination allows you to benefit from the strengths of both approaches. However, if the goal is purely wealth accumulation, index funds typically come out ahead. Their higher returns, lower costs, and flexibility make them one of the most effective tools for building long-term wealth. Whole life insurance, while valuable in certain contexts, cannot generally match the growth potential of a well-diversified index fund portfolio. Another important aspect to consider is financial protection versus financial growth. Index funds are designed to grow your wealth, but they don't provide any built-in protection for your family. If something were to happen to you, your investment account simply passes on whatever value it. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.